right, so welcome to our free bi-weekly webinar along with my partner, Fasanya. I'm your co-host, George Ozoude. This evening, we bring on another investor doc who we've gotten to meet and interact with on other physician investor platforms and networks over the past year. It's Dr. Param, Balandandapani. Param is a radiologist and founder of GenerationalWealthMD, a real estate investing company that acquires long-term and short-term rentals in both domestic and international markets. The firm also invests in industrial properties and ground-up developments. In multifamily, Param has grown her portfolio as an operator to over 800 doors and $150 million in assets under management. She is passionate about helping other physicians reach financial freedom and delivers a ton of value, including a podcast and a coaching program. We're excited to chat with Param this evening, not only to hear about her story, but also to get her take on investing strategies in the current market. From challenges with interest rate hikes to inflation impacts, there are so many things that investors must consider today. So holding spaces like this to have open discussion and sharing is super valuable as we navigate. Thanks, Param, for spending the time with our community, and we'll turn it over to you now.
Thank you, guys. So excited to be on here. But yeah, I'm going to start off just talking about my journey. So I am a radiologist in Southern California, and I guess most physicians, I started off investing in the stock market, doing what I'm supposed to do, living the doctor life. And 2019 was a year of transition for me. I was in private practice and there was a merger, contracts were being renegotiated, the terms didn't make sense, and I transitioned to another position. But that entire shift was really taxing on me and my family. And I realized that you think medicine is security and that's what you rely on. I realized that that wasn't necessarily true. I realized the importance of having additional passive income on the side, which wasn't really tied to my time, but also which was something I would have control over. And so I started exploring real estate. I actually had been investing in real estate since 2014, but like most people starting out, I just looked at the cash flow. It was a few $100s, and you look at your physician income and you feel like it's never really going to be meaningful. And so I continued to invest in the stock market. I had a couple of rentals, but when that transition happened in 2019, I really started looking at financial independence numbers. I looked at what my passive income would be from my stock portfolio, which was, I think I had about 600,000 in there. And that's when I learned about the 4% safe withdrawal rate. And I was like, okay, so that's $2,000 a month I'm getting from that portfolio. And that was after 10 years of working as a radiologist in a high income subspecialty. And that was scary because my number was 10,000. And then I looked at my real estate and I just maybe a couple of $100,000 in there. And I saw that portfolio between, it was throwing out 2,000 in cash flow, but it also increased in value. So there was all that market appreciation that happened over time. And I realized that I was getting about 6 times the passive income from real estate than I was from the stock market. And that was my shift. I really started accelerating my real estate growth at that point. I acquired long-term, short-term rentals, started tapping into tax strategies. I was doing all of that. But that was also the time of the pandemic. So 2020, and it was another time of huge transition for most physicians. I'm sure all of you experienced this. I had little kids, they were 2 and 5. And so suddenly I was fortunate enough to be working part-time from home because I'm a radiologist, but I was juggling more than I could handle. I had the kids and then I was working, and the model that I was working shifted also. I'm a breast imager and I was beginning to read more plain films. It wasn't necessarily what I signed up for. And there were many nights where I would just catch up on the list between taking care of the kids and reading from home. I would stay up late and try to catch up, and I was up till midnight to make sure the next day would be lighter. And I realized that I couldn't continue to do it. And looking back, I guess, in a sense, that was burnout. But fortunately, by that time, by 2021, I'd amped up my real estate to the point where just cash flow from my real estate, without factoring in market appreciation, forced appreciation, tax savings, debt paid down, without factoring in any of that, just the cash flow got me to my financial independence number, which was 10,000 a month. And so I was able to go down to a day a week in medicine. And so that completely transformed everything for me. It gave me the ability to spend more time with my family and really take control of things. And with that transition, I realized I wanted to talk more about it because finances is not something we necessarily talk about. Investing in real estate, there's so many people doing it, but I would say a small percentage, but no one really talks about it. And so I started the Generational Wealth MD community. It was a small WhatsApp group, and that's how we started, a few hundred people. And now we're at 10,000. And the goal has been to just educate. It's exactly what you guys are doing. Educate and spread the word about real estate investing, what the benefits are, how you can do it. And what I realized is that there are so many, like all of us traditionally, we know about the 401ks and what you're supposed to do. But there's so many barriers to investing in real estate, and there are so many limiting beliefs. I don't think I have the time. I don't think I have the know-how. So what we've been trying to do is just educate people and break those barriers so more and more physicians are able to tap into the life-transforming returns that real estate has. And so as I was doing that, I was talking more about direct ownership, buying your own long-term, short-term rentals, and tapping into those tax strategies. And I realized that the majority of people in our community wanted to invest passively in real estate, especially as physicians starting out. That's what they were comfortable with. And that's when we started GW Capital. And that's the part where we bring better curated deals to our community. And it gives people the ability to invest with us as investors passively. And like you said, right now we're at $1,000 and 180 in assets under management. So that's been great. And I'm passionate about helping children with disabilities in India. That's my new why. I say, we all need a why. It starts off with financial independence. But when you have that freedom, you have the ability to say, okay, what's next? And giving back and working on my nonprofit is a big part of what we do. So so that's just how things worked out.
That's a very great story. Yeah, it's very similar to many of the trajectory that people that were able to get educated early took. But most people are not fortunate, right, to be in this same position.
So it always feels like you're late. When I did it, I was like 10 years out of fellowship. And I was like, oh my God, if I'd known this in 2011, the market was amazing for investing in real estate. So I feel like whenever you learn is good enough, right?
Yeah, you can't time. Yeah, like we also talk about timing the markets. At the end of the day, you have to go through every economic cycle eventually.
Yeah,
absolutely. Yeah, and I was looking at the topic that you want to talk about. So there are many things right now, right? For example, for us, we've had like only one deal this year, right? Last year we did like about 5 deals. So a lot of factors affecting investing right now, right? There's market volatility, interest rate changes, economic uncertainty, geopolitical risk, and then there's pandemic, which is now there's a news trend. And then inflation, liquidity risk, a lot of things happening. So how have you been able to pivot or be able to strategize better this year and probably into next year? And what are your advice for all the LP and even GPs?
Okay, that's great because that's specific, because I talk about everything from short-term rentals and mid-term rentals to multifamily. But when we talk about multifamily, the core concepts are the same. We're in a very different economic cycle now than we were, say, 2 years ago. And so obviously how we did things 2 years ago is very different from what we're doing. Transaction volumes, like you said, that's the biggest thing. Transaction volumes are super low. And that's something that really has affected operators and even investors. They're looking for the right deal, but there are very few deals to come by. And the other thing is that you need to be very conservative about what you're investing in right now. And from an investor standpoint, those are the two big things. We don't have enough deals. And then when you get the deals, how do you know that it fits your risk pattern? And I'm sure like this is exactly what you guys are seeing. As GW Capital, what we've done is definitely in terms of our strategy, there's been flight to safety, right? Initially, we were doing deeper value add deals and the kind of debt that we took on was very different. Now we're doing more class A assets that are cash flow heavy from day one. We want to make sure that's coming in because there's safety in that. We're also doing a lot of loan assumptions. That's almost the only way for the numbers to make sense in any market. Just the way things are right now is like the last 2 deals were both sub 4% loan assumptions. So the one that right now is like a 3.1% agency debt that we're assuming for 7 years. The last one we did was 3%, again, assumable loans. That's the only way to make. I think the other thing that people are doing is build to rent is again big right now. Those are almost the only 2 ways to make numbers make sense, because otherwise it's not penciling out unless you're being super aggressive in your assumptions. And I think a lot of us, just with the way multifamily is right now, with a lot of assets being in distress, we know to be very conservative in our underwriting. And so our debt, the debt we're looking at is very different. And we are definitely flight to safety, more class A assets, lesser value add, just to keep that. Even if the returns end up being slightly lower, that's okay. We're educating our investor base. We just don't want to assume too much risk in this environment. That's what we have been doing. Our assumptions are always super conservative, but you guys know this. In most markets, rents are plateauing. So rents are plateauing and expenses have gone up, and we really need to make sure we're factoring in all of those things. And so we're very conservative in our underwriting, and all of that together just means that there are very few deals that actually make sense for us. We're definitely not considering the build to rent space. I believe there are too many variables over there for us to be comfortable. Our investor base tends to be more conservative. And so we're doing more Class A assets, newer builds, deals that are cash flow heavy to begin with, really high DSCRs going in. And we're able to do that because we're assuming those loans. And we're trying to stay conservative. Like all of us in this space know that as long as we're able to hold on to these assets till 2025, we are going to see things shift. Already inflation is at around 3%. Hopefully you've seen the last interest rate hike, and we don't anticipate rates to go down before Q1 of 2024. But once they start dropping, we know that the market cycle is going to transition. So as long as we can hold till 2025, and that's what we're with each of the assets that we already have in our portfolio and the new ones that we're acquiring, as long as we can hold on, we'll definitely again be able to see that upswing. But yeah, we're super conservative in what we're doing right now. But I think what we're seeing in the multifamily space is that there are assets in distress. And I think for limited partners, there's a lot of worry because you're hearing about Applesway and you're hearing about all these assets that aren't doing great. But the important thing to remember is that most of the assets that are in distress, and I think you'll agree with me, are those that were acquired in, say, 2021, towards the latter half of 2021 and the first part of 2022, where no one really saw interest rates going up to this extent. So they weren't underwriting for that. But they also assets that were acquired in that period also didn't see that upswing in rent growth that everyone else saw, anyone who acquired in 2020 and the first half of 2021. And so that's a small subsegment. And if you have deals that are over there and you're seeing held distributions, then yes, that's a small subsegment. But for the most part, anything that was acquired in the latter half of 2022 and after that, I think most operators are being super conservative right now in terms of rent growth assumptions and expenses. Everyone knows to have those rate caps factor all of that. And I think more and more people I see in the space are just going for fixed rate debt at this point. If you're a limited partner and you're looking at those deals, I'm sure you're educating your investor base. We do that too. Debt is a big part of what we're seeing, really looking at those assumptions and making sure those numbers pencil out. And then I also say, I think it's important for investors to think this is a whole spectrum, right? You have opportunistic deals, which are your ground up developments. You have value add, and you have the core and core plus space where you're buying assets that are high on cash flow. You're not really going in and the plan isn't to do massive value add. So there are fewer variables over there. I think it's important for investors to know where they fall on that spectrum. So they're picking deals, and most operators are working across that spectrum. So you can invest in deals where you're comfortable based on your risk appetite, and there's still so many opportunities. I think this is like, we're in a recession and we're going into recovery. This is the time where we have tons of opportunities. And if you're thinking I should stay on the sidelines because of everything that I'm hearing, my firm belief is that those assets in distress are the ones that were acquired in that time frame, and we're way past that. What we're going into right now, what most operators are going into, is more conservative assumptions and safer deals, and we are trying to tap into the upswing that we're looking for in 2025. So as long as you're vetting your deals accurately, you know what you're doing, I think it's still a really good time for limited partners to look at investing in real estate. For me, the whole thing is, if you're not putting your money into real estate, what are you doing with your capital? So with just holding it in, say, a CD or a savings account, if you feel like you're getting 4 or 5%, remember you're paying taxes on that at your marginal tax brackets. That's not really your end return. You don't have those tax efficiencies. And then in the stock market, if you're putting your money over there, which is the other place you naturally put your money in, Vanguard is projected for the next 2 to 3 years, index funds like the S&P 500 to have a 4 to 6% return. So I always tell my investors, like, look at where else you would put your capital, and then look at the risk and returns over there, and that's how you make your decision.
Awesome. A lot of pearls in there. And I definitely agree on one of the points you made regarding setting expectations for the LPs as far as the returns. It's not going to quite look the same as it did 5 years ago.
Yeah.
And that is okay. I've invested in deals where on the pro forma, the cash flow has been 5%, whereas 4 years ago, the pro formas are usually between 8 and 10%.
Yeah.
And if you understand the cycle, you understand that this is not unexpected. And little lower cash flow could be something that you give a little ground on. You're still potentially going to get upside with a capital gain. You're potentially going to get tax benefits. So there's some other upsides that can also contribute to the overall return.
Yeah,
so
absolutely.
I love that point about prepping LP.
I know. And then I have people who come and say, oh, my CPA said you're getting a 5% cash flow annually from this deal, but you're getting 5% in CDs. But look at the tax efficiencies. You're paying taxes on that at your marginal tax bracket. And our returns are maybe 5% in cash flow year one. But if you're looking at average annualized returns, that's still in the mid to high teens. And that's what you need to take. And you need to compare that to your actual return once you factor in taxes for stocks or bonds. And that's the actual comparison. Like you said, George, it's about this market, right? You can't compare stock returns from 3 years ago to real estate returns in the current market. So yeah, absolutely right about that.
Had a question about short term since I've known you were in that space. I even asked a year ago, I tapped you for some advice on short term rentals. That's seen a lot of headwinds recently regarding regulation. Even before that, in certain markets with saturation. What's been your approach to de-risk that? How do folks approach short term rentals in this day and age?
Short term rentals, and I say when we talk about multifamily, we say core plus, value add, and opportunistic. And it's the same thing even in the spectrum between long-term rentals, mid-term rentals, and short-term rentals. Short-term rentals are higher risk, and that's for those very reasons, right? They do tend to be affected more by macroeconomic trends. They do tend to be affected more by regulations. And where we've seen most regulatory changes has been in metro markets. So I know Dallas has seen that. New York is beginning to see regulatory changes. So whenever we see those changes, if you're in a metro market, we always, like when we tell our students, when you're going into a metro market with a short-term rental, you have multiple exit options. You could run that as a mid-term rental. You could run that as a long-term rental. So that kind of gives you protection. But you're right, we're also seeing those changes in markets like Big Bear, Yosemite, which are traditionally considered vacation markets. And there is inherent risk when you're investing in short-term rentals. And when you go in, you're aware of that. Now, there are markets like the Smokies and the Florida Panhandle, which we love, which are they are your typical tourist destinations. Regulations over there don't change that much because that's a big part of their economy, and they're very pro short-term rentals. And that's something that you assess when you go in. And I think the only people who, if you have the ability to invest as an out-of-state investor, then we always recommend investing in those markets, right, that are built for short-term rentals, that are very pro short-term rentals. And that's my take on regulations. If you had something in Dallas and the regulations changed, then it's very easy for you to pivot and change into a midterm or a long-term rental. But if you are picking your short-term rental, you want to make sure you're going into those markets where the regulations have been established, where they're going to be very friendly and favorable. But then the other thing you talked about, George, is again a big concern, right? Saturation. And so we're definitely in a very different short-term rental market today than we were, say, 2 years ago, where anyone could own a short-term rental and you could list it and you'd make a huge profit, right? But that was because of the surge in demand that we saw with the pandemic. You're right. There has been, like, a lot of the markets are oversaturated, but I want to bring it back. And so if you are a short-term rental owner, you can't just set it and just let it go. You have to really market your short-term rental. You need to run it as a business. And I tell people you almost need to be an entrepreneur to run a short-term rental these days, because it's not just setting it up and having all the systems in place. You need to keep monitoring it. So if your revenue is dropping, there are things that you need to be doing on a regular basis, monitoring and seeing what your competitors' rates are at, and do you need to modify your rates? Do you need to go in there and change things about how do you work with the algorithm to make sure you have visibility? So those are things you need to stay on top of. And if you aren't necessarily, you don't have the aptitude to do it, or you don't have the time to do it, then that's when your revenue starts dropping per se. Yes, as long as you're doing all of those things, all of our members who are in those really strong short-term rental markets where there's a lot of traffic and they're really on top of their rentals, they're still doing great. But it mandates you to actually put the time and effort into it. So you can't just own a short-term rental and expect to do well. But that being said, the data, and I think there's a lot of clickbait, George, you probably saw this. There was an article which said short-term rental revenue is down 50%. It came out, I think it was a month ago. And the truth is that's not necessarily true. That's just an interpretation of the data. If you look at AirDNA and short-term STR Insights, they came out with actual data for each of those markets to show how revenues have dropped. And there has been an overall drop in revenue compared to, say, 2020 and 2021 when we saw those peak revenues, but it's still higher than 2019 revenues, right? So we are seeing a normalizing of revenue as far as short-term rentals is concerned. And if you actually look at the data, we're probably coming back. And we're seeing that with rents also, right? Rent growth is dropping. All of that is just normalization. But in the popular short-term rental destinations, it still makes sense to run short-term rentals, and you're still getting a higher revenue for the amount of work that you're putting in as physicians, short-term rentals also give you the ability to tap into those tax savings, which if you're working full-time, there's really no other way to tap into it. So as long as you're doing it right, if you're in a metro market, you have exit options. If you're running it in a pure vacation market, as long as you're on top of it and you know exactly what you need to be doing to increase your visibility, you're competitive in terms of your rates and your cleaning fees aren't excessive, you have the right cancellation policy. As long as you're doing all of those things, you're still doing well. But the important thing is again, it's similar to multifamily, right? When you go in, you need to underwrite and make sure that property is going to cash flow, and you need to be very conservative in those underwriting. So you can't just go buy something and expect it to do well. You buy right, you buy in the right market, you buy the right property, and then you need to run it as a business and make sure that you're constantly on top of your metrics, you're constantly on top of your visibility, and you're doing all the right things. And so if you do that, it is still a profitable strategy, but you really need to be on top of it. So I stratify people as like investors, which are your limited partners and syndications, your buy and hold investors, and then your hustlers who are like, okay, I'm going to do the burst strategy, do a rehab, force appreciation, and then just let it ride and let my property manager take care of it. Your midterm rentals and your rehabs come into that category. And then I say your entrepreneurs, who are your general partners, and your short-term rental owners, because you run that as a business and you don't get to take any shortcuts over there.
Yeah, no, I believe that those destination locations are still going to be in demand. A follow-up question though, in order to decrease risk, a lot of us feel like if we're not boots on the ground in that area, it's more risky. But if we want to get into the STR game, it's probably going to be out of state or out of city in one of these destination sites. What are like ways to de-risk that when you're an out-of-state investor with these short-term rentals or even with a multifamily?
I feel like that applies across the board, George. I think most people feel that even about long-term rentals or multifamily, they feel like I have to be boots on the ground. And I started out as an out-of-state investor, so a lot of those limiting, because my mentors were out-of-state investors, and so a lot of those beliefs were kind of shattered for me up front. I think at the end of the day, even if you are a physician and you're a surgeon and you get a call, unless your boots on the ground or you don't have a system that's really robust, you're not going to be able to go and take care of everything. That's just going to be so draining, you'll burn out. So I think even if it is something that's local to you, having those systems in place is going to be really important. So that doesn't necessarily change when you're an out-of-state investor, right? So at the end of the day, it is going to be those systems that you build. So having cleaner and having a backup cleaner where you know that in the event that something goes wrong, you have someone you can lean into. Having 2 handymen who are really good and reliable, I think that's really important for short-term rentals. Some of our members like using co-hosts, so someone who can take care of things while you're not there. That's another model. And then obviously you have your property managers, but honestly, even with your property managers, you need to at least stay on top of the numbers and make sure you have those systems. And it may still be, even if you have a property manager, it may make sense to still have some degree of contact with your cleaners or handymen, so that if you feel like your property manager isn't as effective as you need him to be, then you have the ability to take over and transition. And I hear people say this all the time. I had a student who had a short-term rental in the Florida Panhandle, and she was in Colorado, and she was my one-on-one client. And there was a guest, because they're not necessarily tenant, who wouldn't leave, and he overstayed. And she called and she was like, oh my God, I wish this property were closer to me. And I was like, what would you do? You would go and take care of this? No, we need to have systems in place. And so her handyman assisted the HOA, and the sheriff came in, and they moved the guest was asked to leave. That's about it. So it seems overwhelming, but the truth is you're not the person who needs to be on the ground taking care of these things. You need to have people that you trust who can do it. And so building those systems is going to be important, even if it is within a 2-hour drive. So I think that's a limiting belief, because, and I'm an out-of-state investor and I have properties locally, and I think my local properties are a bigger drain on my time, because I feel like I do a better job at managing them, and I start micromanaging and I get so involved. My out-of-state properties, my property management team, I just let them handle it. And in terms of, I think as physicians, we tend to not place high priority on our time, and we value our time very little. But if you look at the amount of the time that I spend in my local portfolio, I do my rehabs myself. It may be okay initially, but you get to a point where your time becomes more valuable, and you need to build out those systems anyways. And so if you're doing it from the scratch, I feel like my out-of-state portfolio is definitely more efficient, time efficient for me, because I'm forced to build those systems. And so, yeah, that's my belief, that you need to build those systems anyways. And I don't want any physician being the person who's necessarily taking care of those issues.
I definitely see that, because we do like self-storages here, and I do have some local ones. And I've been tempted. I went to cut the lock myself once in a while. I'm like, it's a Saturday, but I do have a boot on the ground. I have people. And we have one in Pearland, Houston, where if something like that happened, I just call my boot on the ground, $20.
Yes.
Go cut the lock. So yes, you're right that we almost was like we're like self. We basically spend our time in a very non-meaningful way if we do that. So I definitely see that point for sure. But I also want to ask some question about diversification. Because our strategy is there's always different strategy for investment. Some would say over diversification is bad. Once you're good at something, just go all the way in.
Yeah.
And some people will be like, just diversify. So for example, we do senior living, luxury senior living, we have self-storages, and we have multifamily, even though multifamily is the core for our investors. But we also started doing oil and gas, right? We have an oil and gas funds we're doing currently. So for us, we feel like that kind of helps you pivot, ability to move, either based on what the economy is showing. But how do you do that with yours? Because I see that you're leaning mostly into multifamily, right?
Yeah.
So how do you deal with diversification?
Yeah, that's a great question. I actually had a podcast episode recently, diversify or not to diversify, because I think you can find arguments for both sides, right? I think when we start out, there's a tendency to diversify quite a bit, but there's always the right balance for an individual, right? And it depends on how educated you are and how much you understand the asset class. And so I think when you're beginning and you don't really know that much, you have tendency to get into multiple things because you want to make sure you're hedging your bets, right? But the more you educate yourself, I think it makes sense to then start focusing so that you're taking your strengths and you're focusing on them. But I think the thing with the real estate is that there's diversification on multiple levels, right? So the first question is, okay, how much of my portfolio needs to be in real estate versus stocks, right? So there's diversification on that level. And then when you start narrowing down, then it's, okay, so am I going to do just multifamily or am I going to do multifamily and self-storage? So that there's that level of diversification. But then even if you come into multifamily, you have market diversification. So we're invested across 5 different markets in the United States. And then even within that, you have, okay, is it a value add opportunistic deal? Is it a core plus deal? So there's diversification on so many levels. And I think Warren Buffett said something about diversification killing your returns or something. I don't remember the exact phrase. I had it written down when I did the podcast episode. But you think you could argue for both sides. What I'm realizing is that in terms of really knowing your market really well, understanding everything, and in terms of being able to pick and choose, I feel that focusing right now on just multifamily makes sense, because even within that, we have sponsor diversification, we have market diversification, we're picking asset classes across the spectrum. So I still think we have enough diversification, but we're focusing on energies over there right now. I feel like it's evergreen. There's not a lot of operational inefficiencies over there, and it's something we understand really well, where we know we're able to vet and do our due diligence. I've considered adding oil and gas and maybe car washes and ATMs just for the depreciation and the higher cash flow. But even within the multifamily, we're able to do like class A and B. And so it still gives people tons of options. And so for now, we're sticking to it. I think it's such a personal decision. But what I feel in my journey is that initially I started spreading out while I was starting to learn. And then there's a natural tendency to start to focus in on what you really understand well. And so that's just my take, and that's the way I like to approach it. But I don't think there's a right or wrong answer to that. How do you guys feel when you're spread across the different asset classes?
I definitely feel, obviously, you always partner with someone that's even more knowledgeable than you.
Exactly. And they're niched in on that. So that's their zone of genius.
So yeah, my mentor is more diversified. And I think that's where mine came from. He does like self-storage, he's the senior living, does all of it. So I tend to just follow how you were trained. But you're right, that over time, so once you feel like, okay, my knowledge here is like 90%, my knowledge is 60%, perhaps you should just intensify on the one that you're best at. And also, like you said, short-term rentals, you're doing that. And you're doing, so there's multiple, even types, multiple states, different zone, different area, class A, B, and C. And there's more than, I read an article that shows there's more than 100 ways to make money in real estate. And I think it was bigger pockets or something like that. So yeah, definitely.
I think about it in a couple of different ways. I think about it first as me, the investor. And then now that I'm on the co-GP side as investor relations and capital raising, I think about what my avatar is looking for. And that can be
Yeah.
different things. And even
Yeah.
though we're all physicians, we may be in different seasons. And
Exactly.
so people may want more aggressive cash flow versus more conservative plays, or somebody
Yeah.
may keyed in on wealth preservation or tax benefits. I've learned to separate kind of what I want as like an LP, and I've been an LP on many
Yeah.
before being a GP, and then catering to who I'm sitting across.
Yeah.
Personally, I love more conservative investments, so I played more in the multifamily value add because it's obviously an existing
Stabilized
asset.
value add.
It's stabilized. It's a cash flowing. One of my mentors talked about hitting singles versus swinging for the fences. And I was of the mindset of, look, I can just keep hitting singles with these value add multifamilies.
Yeah.
I focused on and concentrated my investing there, but I do invest across other asset classes and things that make sense to me. We're always going to need energy, so I'm in mineral rights and oil and gas.
Yeah.
We're always going to need food, so I'm in agricultural farmland syndication. Thinking strategically about things that we'll always need is how I diversify my portfolio, but I do lean towards what I think is conservative with the value add multifamily.
Yeah, absolutely. And even within real estate, you can pick and choose where you want to stay, and it's the same across asset classes. You have so many options. Once you get in there, you realize you can't box any asset class into just one kind of asset.
For sure. I see we have a question from John. Go ahead and come off mute. Yep.
Yes, sir. Thank you for organizing this. I do have a question for you. In terms of tax savings, how has multifamily been of benefits to you? Sorry, short-term rental.
So those are two very important questions, right? So if it's a different situation for me because I have real estate professional status, because I spend most of my time in real estate. And so I qualify for that, which means that I can use the losses from my K1 on, because we invest as LPs in all of our deals. I put multiple six figures into all of my deals, and that goes into the LP side. And so I get K1 losses like all of our investors do. I get to use all of those losses against my active income at this point because I have real estate professional status, right? And so real estate gives you the ability to do that. But I think if you look at it from the perspective of our investors, there are two different ways, right? So someone on the outside, when we do short-term rentals, and this is likely why George is doing it too, and you're working a full-time job and you do short-term rentals, that's when you're working a full-time job, you don't necessarily get to qualify as a real estate professional. So if you want to shelter your active income from taxes, if you want to shelter your clinical income from taxes, then the way to do it would be so oil and gas is definitely an option, and George obviously talks to you guys about that. But the other way to do it is through short-term rentals, right? When you own a short-term rental and you spend 100 hours on that short-term rental or meet one of the other criteria for material participation, then you can buy $1 million short-term rental and you could get up to, this year it's a little lower, but anywhere from $200,000 to $250,000 of your clinical income can be sheltered from taxes when you use the right strategy. And so there are certain criteria for you to meet. That's one way. That's possibly the only way through real estate to shelter your clinical income from taxes. And that's why a lot of our physicians like those short-term rentals. But that comes with added risk. And that's what we were talking about in terms of regulatory changes and fluctuations in revenue. But the other thing I think investors need to remember is that this is what we were talking about before. There are tax efficiencies inherent to multifamily investing, even as a limited partner, that you don't get, say, if you put your money in a CD or if you put your money in a debt fund, right? Because you likely are paying taxes, or if you're investing in REITs, right? All of those are tax inefficient, which means your distributions, you're taxed at your marginal tax bracket. But when you invest as a limited partner in multifamily, you get depreciation. So you get to take that. And although that you get them as passive losses and not as active losses that you can use to shelter your clinical income, those passive losses are yours and they're sitting in your passive bucket. So every time you get cash flow from those properties, on paper, you have losses. And that means that you can let that capital grow without paying taxes on it. So there are tax efficiencies to investing in multifamily, even if you don't qualify as a real estate professional. So I think a lot of people say, especially in active investing, they'll say, I don't have a spouse who can qualify as a real estate professional. I can, so I don't think I get the tax benefits. That's not true. Whatever income you make from real estate, in most cases, even if you're a limited partner or you're investing actively, you're able to defer taxes on it by either laddering or 1031s. And with syndications, you can't 1031 just your interest, but the entire syndication may be able to 1031 into another asset. So you have the ability to keep all of your returns from real estate tax efficient. And if you get to the point where you're generating six figures in income from real estate and all of that is tax deferred, then that's huge. And so I don't think physicians need to necessarily think of Can I use it to shelter my clinical income? That's one part of it. But even if you aren't doing it and you're getting 6-7 figures in income from real estate on the side and you're not paying taxes on it, that's huge. We talk about compound interest and being the eighth wonder of the world. And I'm like, what about leverage that we're using over here? And the tax efficiencies, that is going to have a huge impact on your wealth building over time. And so I like to break it into those two different things. As if you either can shelter your clinical income from taxes or whatever wealth building you're doing, all of this can be tax deferred if you're employing the right strategies.
So assuming I have a spouse that qualifies as a real estate professional and she's managing like one of our Airbnb deals, and then I'm getting like passive losses from other LP deals, does that qualify me to use all those depreciation against my active income for the other LP deals that
So it would depend on two things. So Airbnb, so the IRS doesn't allow you to combine short-term rental hours with your long-term rental portfolio. So she'd be hitting those criteria separately. Now, if she qualifies as a real estate professional, which means the majority of her time is spent in real estate compared to any other income-producing activity, and she spends 750 hours on real estate in a year, which means on average 15 hours a week is spent on real estate. If she does that, and then she has to hit a second material participation criteria. So she has to spend, so the 750 hours is separate, but of those, at least 500 hours she needs to spend on your personal portfolio. If she's doing that, if she's hitting both of those criteria, then you can do something called a grouping election, and you can group your syndication investments into your personal portfolio for tax purposes. And then those K1 losses can become active losses that you can use against your clinical income.
Yeah, makes sense. Thank you very much. One final question. So Dallas recently passed a law stating that they don't want short-term rentals in residential areas, and I think it's going to go into effect this December. As someone who is in the STR space, how do you navigate around these waters?
Yeah, I think it's only for areas that are zoned for single family. But if that's the area, one of the areas that you're in, and you have a short-term rental over there, and this is what we were talking about in the beginning of this episode, is that if you're in a metro market, then there are two strategies out of that. You can rent that furnished rental out as a midterm rental. And we have a lot of students who are doing the midterm rental model, and you could do it for traveling nurses, but the income isn't that much. But if you did it for families that are displaced because of insurance needs, insurance companies tend to pay very highly. So you could get anywhere from 3 to 4 times what you would make as a long-term rental with a midterm rental. Excuse me. So that's one way to pivot, is because you have a furnished space and you're already probably listing it on some of the same platforms you'd be listing your midterm rental on. So that's one thing to do. I'm sorry, excuse me. So sorry about that. So you would either pivot to a midterm rental or a furnished long-term rental model, and that would probably be your strategy.
Thank you.
We have another question here, which thank you for the great discussion. When you use 100-hour short-term rental loophole, how do you track your hour? Can you track after getting under contract, or do you need to wait until you close the house?
So very important questions. I like our community, we like to use Clockify or Reps Tracker, which is something like, it's an app on your phone, so you're tracking as you go. And I've gotten this from CPAs who are very conservative. You can include all your acquisition hours. So once you identify the property, even before you submit an offer, anytime you spend on that specific property, talking to your agent, underwriting, talking to your designer, talking to your lender, working on insurance quotes, all of that qualifies. So acquisition hours do qualify towards short-term rental material participation hours. So you can include all of those.
You also asked the same person, during tax filing, I know you're not a CPA, so this is not
educational purposes only.
Yeah, for educational purposes only. During tax filing, do you file under Schedule C or E?
So that is another great question. So ideally, with a short-term rental, you could do both. And if you file on Schedule C, then you also have to pay yourself self-employment taxes. And some CPAs will actually take a stand one way or the other. But the honest truth is, and like I said, I've spoken to multiple conservative CPAs, you can file on Schedule E as long as you're not providing services like breakfast and laundry services or something that's very intense, right? So as long as you're not providing those services, which most of us don't for short-term rentals, you can file it on Schedule E, and that ends up being more tax efficient for you in the long run.
All right, I had a question swinging back towards multifamily, and I think you touched on this when you mentioned you're focusing more on Class A, B plus, Class A right now, things that don't require as much value add and can still cash flow. But I've been asking a lot of my mentors and colleagues about the potential stress that regional banks can fall into because they're carrying most of these office commercial loans that are supposedly going to be in trouble over the next year or so, which may put a stress on their liquidity and their balance sheet, and that may roll over and impact the multifamily syndication and investing space. What's your thought or take on that? How is it potentially affecting your investment strategy? Maybe not now, but going forward for value add multifamily?
Yeah, that's a great question. And I think so it's just opinions, right? So I'll tell you what my take on it is. A lot of the debt that we've assumed recently it's all been agency debt. And I think as far as Fannie Mae and Freddie Mac are concerned, they have the capacity. I believe that because transaction volumes are low, they have the higher capacity to actually lend now than they have in the last few years. And so they're on standby. There's a lot of capital available there. So as long as we're looking at assets which qualify for that kind of debt, where it's stabilized and over 90% occupancy for more than 3 months, then that's definitely a great option. But I think there are also a lot of debt funds that people are putting together, which is probably going to be another option for another backup option. So although there is stress on regional banks, which, that is true, and we may even see more bank crisis coming up in the next few months. I think overall, as far as the lending space is concerned, between agency debt and all the debt funds that are poised and ready to act, my opinion is that we will be okay, that we have enough of a buffer over there. That's just my take on it. I hate saying things that are speculative because no one really has a crystal ball, but just looking at what is available at this point, I think those will be our backups.
Yeah, it's true. There's definitely a lot of what they call dry powder sitting on the side.
Exactly.
Yeah. And everybody's looking at this potential thing from happening. But you're right. No one really knows. But yeah, it's a very interesting time in a specific angle to look at.
So, yeah. So going forward, so do you go for we have like about 9 minutes. So do you want to just speculate on what you think in the next 5 years, the macroeconomics, and what do you think the future is for multifamily? And even short-term rental. It's multifamily, but I consider it to be separate on its own.
Absolutely. No, I think that I don't think interest rates are going to go down. So I'll just tell you what my take is, right? This is what I think is going to happen. Again, like I say, I hate speculating. So we underwrite for worst case scenario. But I think what's going to happen is Q1, Q2, 2024, we're going to start seeing interest rates start dropping. As that happens, I anticipate cap rates to compress. And 2025, all those distressed assets, we may see those assets come on sale, maybe be great buying opportunities in 2024. And so if you have capital and you have the ability to go and take advantage of those opportunities, that's probably going to be 2024 for us. 2025, I'm assuming that's where we see stability. We start seeing cap rate compression and rates going up. And we're again going to see, it's all cyclical in my opinion. So that's going to be the period of recovery. And honestly, I believe that the lowest risk is during recession and recovery as far as the cycle is concerned. When we're in hypersupply and when we're in expansion, that's where there's a higher risk because we're in the upper part of the cycle. So I think it's a great time. The next 2 years, they're going to be great buying opportunities as long as operators, we have the ability to hold on to our asset till 2025. We're going to see a market upswing again, and our investors will do well. I still think that, yes, with multifamily, with real estate in general, the ability to hold is the major thing. We don't see that as much in the single family space with short-term rentals because we're looking at long-term fixed loans. And so as long as you can pay the mortgage and you're breaking even, as long as the property isn't sucking money, you're going to do just great. Over time, you will eventually, for people who are getting into the short-term rental space now, they will eventually refinance when rates go down, and then they will hold that property long-term, and their biggest ticket item, their loan expense is fixed and their revenue will keep going up with inflation, they will do well as long as they know how to manage those properties. And again, it's the ability to hold on to those properties and ensure that they're not negative. That's all they need to do with the short-term rental space. With multifamily, it's again cyclical. They're going to be good buying opportunities. We are going to see, I anticipate us to start seeing cap rate compression about 2025. And then going forward, I think anyone who sticks with a plan. And this is the time, I think this is a time of, I think recession and recovery, I think are definitely the market cycles where there's lower risk, there's good buying opportunity. And if you are consistently it's like dollar cost averaging with the stock market, sticking with a plan and betting your deals and putting your money in, I think you will do good.
Yeah, we're definitely looking forward to actually cash out refinancing so many properties right now. So many equities are locked in the properties, and you're like, man, I can just return all the investors' money right now if I can refinance.
Yes.
Are you guys seeing the same? You have the same issue in some?
Not necessarily, because I think as far as the business plan was concerned, as long as I think mid-2024, if we are in a position to refinance at that point, then we should be good with some of our assets. And some of our assets, it's going to be 2025. I would like to see those rates start going down nicely by mid-2024, and that'll be good.
Okay, thank you very much. We really enjoy this, and I would like to give you the opportunity to tell us what you're working on right now. I saw that you have a coaching program.
I love to, and I know there were a lot of questions about short-term rental. So anyone who's in the short-term rental space or direct ownership who wants to learn more, we do these free 3-day live events twice a year, and we have one coming up next week. And so if anyone wants to join, it's GenerationalWealthMD.com/event in lowercase. And we talk about everything from long-term rentals, mid-term rentals, short-term rentals, tax savings, a lot of what we talked about today, real estate professional status, strategy, and how to build a recession-resilient real estate portfolio. So anyone who wants to learn is more than welcome to join. It's completely free. It's 3 days of live coaching, Q&A, and it's a fun event. We usually have 3,000 physicians on there.
Okay, awesome. You also have a regular other coaching program?
We do. We have a group and one-on-one coaching program. Doors to that also open up in mid-September for that also. And that's GenerationalWealthMD.com/waitlist in lowercase. And you can check that out also.
Okay. Someone said, love your podcast.
Oh, thank you.
Wow.
Yes. Sometimes I feel like we talk about the same thing over and over again, but there are like lots of questions that need to get answered.
That's reinforcement.
Yes,
that's okay.
Exactly.
George, you have anything to add?
No, I just want to also say thank you again for coming on and sharing with our community. I put your website up there. If there's any other way or any other platform that folks can reach you on, email or social media, happy to share that with folks too. But I just wanted to reiterate saying thank you.
Yeah. Thank you, George. Yeah, we have a Facebook group. It's free and it's a space for people to get together. It's the same name, Generational Wealth MD. But I think you have a lot of limited LPs, limited partners, investors, and syndications on here. I just put out a guide. It's almost like the hands-off investor is like the gold standard for limited partners, but I went through it and it took me a long time to get through it. So I put together like a 30-page guide, which I think is like really helpful for someone who's trying to vet deals. It has a due diligence checklist. So if anyone's interested, it's GenerationalWealthMD.com/guide in lowercase. And I'd love feedback on it because we just put it out, but I'm hoping that simplifies the process for investors and syndications. Thank you, guys.
Awesome. Thank you so much. And thank you for everybody for attending tonight. I know this is a holiday weekend, so thanks for spending the hour with us. We'll be back in 2 weeks with another great conversation. And so we will see you then. We'll sign off from here.
Okay.
Thank you,
everyone. Take care.